Hi guys, so this is a continuation from the first video, which is a review for the G7FX course, forex course, founded and created by Nirav Vadera. Alright, so if you haven't watched the first video, go and watch it. There's a link below in the YouTube description. Before I continue, I just want to touch base with the refund policy again. So if you were to pay for his course, you're given 30 days, within 30 days to get a refund, or you have to watch the first video. If you watch the first, not the first video, the first module, and once you watch that first module, you can't get your money back. But if you want to see what's in the first module, just go and watch that first video. Alright, so it's whichever one's first. Okay, so now that I've mentioned the refund policy, I'll move forward from there. That's his website. So he's got two different courses, alright? The one I enrolled in is the technical analysis course, and he's got another course which is the fundamentals. It's like macroeconomic news and things like that. But I've only just enrolled in the technicals course. So in the technicals course, he's broken it into two sections. One's the basic foundation course, and the other one is pro trader course. I've already recorded the foundation course in the first video. Now I'll tell you what's in the pro trader course. Not in great detail. I'll just give you a quick summary, a quick briefing of what's in the modules. Alright, so we'll just have a quick look in the first module here. Alright, so what he wants his students to do is put 70% of their mind and focus towards these things listed here. Alright, so the market profile and volume profile, they're exactly one and the same, so I'm not sure why he separated that. You got the auction market theory, which is the depth of market, which I'll explain all that later, and the VWAP. Alright. Also the fundamentals, which you have to pay extra to do that course. I'll explain. I'll give you just a touch on each of these soon. Alright. So we'll move on from there, and okay. Alright, so in the first video that I created, I said from modules 2 to 4, he goes into detail about the depth of market. Okay, so he spends a long time talking about the depth of market, but we don't end up using it anyway. So he doesn't use it. He uses the volume profile instead. Right. So all it is with the depth of market, it just tells you where people are buying and selling at different prices at that moment of time. Right. So once there's people that are buying in certain prices, then it'll disappear. Right. So it doesn't stay static. It's dynamic. It's moving all the time up and down. And wherever there's an area of a lot of buyers and sellers at certain prices, then it'll form a line which is called the point of control. Alright, so like I said, he's using volume profile instead. So it's exactly the same like the depth of market. The only difference is you can't see all the bids and asks going up and down. Alright, okay. So with this volume profile, what he's doing is he's merging a lot of the past history. Alright, so I'll just go to a section where he's doing it so you can understand. Alright. Okay, so what he's doing is he's merging a lot of this past history together. And so I'll just give you an example so you understand what I mean. So I'll pop onto the trading view. So this is TradingView. You can't see the market profiles on higher time frames. So I'm on the day. So for me to be able to see that market profile, I need to knock down to earlier time frames, called micro. And the problem with his course is that everything's based on micro time frames, anything from around 1 hour or less. It's normally about the 1 hour, 15 minute, or 5 minute. He never mentions anything about macro. Macro is like 4 hours and over. Alright. So this is like day 1, day 2, day 3, day 4, and that's all past history. So once it's the 24 hours is up, it goes static. If it's within those 24 hours, like for today, this line, point of control line, will keep going up and down. It's dynamic, alright. It keeps going up and down, and once the day is over, it'll become static and it's past history. But what he's doing is he's merging a lot of the past history together, which doesn't work. The theory does not work. So if I go back onto the day, see, if you were to merge a lot of these market profiles on each day together, it's useless, because what's happening is the market makers are pushing prices to new levels all the time. So they keep pushing the market up, price up and up and up. All this past history is useless, basically. Alright. Okay. Now let's get down to a VWAP. Okay. VWAP. Alright. So with the VWAP, okay, so he's created a lot of these standard deviation lines, which in my opinion don't work actually. To me they're actually useless. The only line that's important is the middle one, which is the mean, which is the VWAP line, together with the actual market structure. But all these other lines I would not use at all. Okay, let's go. Alright. So each of these, actually, I'll go to show another, just show, oh, here we go, this is a better one. Alright, so these are different days, alright? So from here to here, that's one day. From there to there, that's another day, alright? And because he only trades on earlier time frames, he doesn't mention in the course about a macro structure, looking at direction of the market on higher time frames. So that's a big mistake, because you need to know what's going on higher time frames in order to see, to have a better prediction of where it's going on earlier time frames, because they all correlate and work together. Right. So what's going on the direction on higher time frames, that'll determine the behavior of what's going to happen on earlier time frames. So his direction, he doesn't really give you a proper fixed entry and exit in the VWAP section. It's very vague, and it's assumption really of where it's going, because like I said, he doesn't know what's happening on higher time frames. So yeah. All right. And the next one is footprint. Okay, so footprint, that's exactly like, is very much the same as the depth of market. Like I said, with the depth of market, once there's buyers or sellers at certain price levels, that will disappear. All right, but not with this. The difference with this is that he's created this indicator for it to accumulate. So with all the buyers and sellers at that price level, it'll stay static, and it'll keep increasing within that candle. But because the market's moving constantly, it's getting pushed to new levels all the time. This information is pretty much useless. It doesn't work, in my opinion, of course. And, so that's just a quick summary of what's in the course. But he goes into a lot of detail, very technical stuff. It's irrelevant stuff that you don't need to know. So that's basically a rundown summary of the course. So I want to mention something else too, so it gives you a better understanding of how the market is structured, because in the foundation course he did mention a little bit about how it's structured, but he didn't explain things properly. So how it works is, like, if you go back in the old days, in the trading markets, it was only hedge fund big institutions that would trade in the markets. So it was only the institutions and the liquidity providers back in the days. But now the market is open to retail traders, which is us ourselves. So, but the liquidity providers do not want to deal with us directly. So then they have created a retail broker, a middleman, to take our trade. So once we place a trade, it goes through to the retail broker, and they send it through to whichever liquidity provider they decide to deal with. And normally what happens is there is a disclosure agreement. So normally if you were to ask your retail broker who are they sending your orders through, which liquidity provider they're sending your order through, they don't normally tell you, because they have a disclosure agreement between that liquidity provider and themselves. All right. So liquidity providers are also called market makers. Why are they market makers? Because they can manipulate the market. They run the market. They control it. They can push the market to whatever level they want, and then they can push it the other direction whenever they want. So a lot of these courses that are out there, including this course, why they're not good is because they don't understand what's happening on the sell side, right? None of us know what's happening on the sell side, and that's full of manipulation, which we cannot control. And that's why a lot of these retail courses fail. And so they don't teach you the whole, all the pieces. They don't give you all the pieces of the puzzle, so to speak. So yeah, so we can't go through to the exchange directly. We can't go through to the market makers directly to place our trades. We have to go through the retail broker. But the hedge funds, big institutions, they get the privilege of being able to deal directly with the primary broker. So liquidity providers could be known as primary brokers, market makers, and investment banks. They're all pretty much one and the same. And so that's how it works. And so I think I covered everything that I should, but actually no, I didn't. All right, so just going back to TradingView, okay, so these volume profiles, just remember it's free. The good thing about using TradingView is it's very user friendly with the mouse. See how you can widen it and then and crunch it up like that. You cannot do that in Sierra charts. It's a very old platform. It's really out of date. And his Narev's indicators, his custom indicators on Sierra charts, it distorts really bad if you were to switch to different time frames. Not only that, because Narev only uses futures contracts, on the futures contracts throughout Sierra charts, there's hardly any data feed for the different currency pairs. So I would only recommend to use TradingView in my opinion. All right, it's got all the best functionality there. It's not costing you a cent to use. So just a bit of a review of the course. So what do I think of the course? Well, what I rate it myself, I would rate it probably 1 out of 10. And so I paid £800 for the course. What I value the course at? Probably only £1, to be quite honest with you. Did I learn anything from the course? Yes, I did. I learned the depth of market. I was not aware of it. But although saying that, it still has not made me a profitable trader. So in other words, that information is pretty much useless to me. Yeah, and that's the problem with all these courses. You're going to get the same problem with other courses too. They're not going to give you the whole puzzle to bring all the pieces together to create the whole puzzle. Because it's only because of the sell side. No one knows, as I said before, it's all been manipulated by the sell side. So all we can do is try and we have to find out which direction they're going, and then we just follow with the direction until they go the other direction. But you need to start from higher time frames first to get the overall picture, and then you work down to the micro time frames, which Narev's theory is on the earlier time frames. So by going on higher time frames, then that'll give you a better indication on earlier time frames on what's happening, because they correlate together, right? They work together, and earlier time frames behave in certain ways according to higher time frames, which Narev did not mention any of that in his courses. His course, as I said already, is focused on earlier time frames, ignoring macro time frames. So I thought I'd just share that with you. Again, this is no hate speech. It's just to give a review so you can understand what's in the course. Please leave feedback, and I'll be happy to reply to your feedback. And thank you very much for watching this video.